Thank you, everyone, for joining our session. And sure you've been enjoying all the different sessions so far. This one's on advancing digital asset option markets through institutional grade data and analytics. My name is John Lagman. I'm the APAC Crypto FX market and product specialist for Bloomberg. And this is definitely a very important topic for me. As you can most people know Bloomberg for the terminal, but the reality is if you don't have the analytics and the data, it's really just a screen. So it's definitely a topic dear to our company. And for me personally, as an ex options trader, is definitely one of the sessions I've been doing this 3 years. And I'm betting this is going to be one of the best ones. Not to say the other ones weren't good, but this is definitely going to be really cool. If it's above your head because there's options, I'm sorry, but it is what it is. But sorry, that sounded pretty bad. I'm now gonna, rather than me butcher the introductions too, I will hand it over to my two esteemed guests. Andrew, we'll start from you, just because A is the start of the alphabet.
Hi, thanks, John, for having me. My name's Andrew. I am head of research at Scholes. Scholes provides institutional grade research, data, and analytics for crypto derivatives.
Oh, Sean?
Yeah, no, thanks for having me as well, John. So I'm Sean. I'm the head of research at Derive. We're the largest on-chain options exchange for ETH, BTC, and HYPE options. I'm a mathematician by training, so I love to get into the numbers and all of that stuff.
Do you have the whiteboard so we can derive equations?
Definitely don't.
Oh, shucks. Okay, I definitely wanted to put everyone to sleep, but anyways, hey, let's get right into it. Maybe starting with you, Andrew. I mean, this is a space that has so much potential. Probably hasn't grown as much as all three of us and anyone involved in options would like. I mean, is there certain things you feel the market still kind of misunderstands most often about crypto volatility or even crypto options?
Yeah, absolutely. I think anyone coming to crypto volatility markets or options markets with any sort of preconceived notions from other asset classes is liable to make mistakes, to misunderstand some of the nuances that make this market tick. So far, so much of the flow, not just in crypto options, but crypto in general, has been retail dominated. We're seeing that materialize still in a slightly different way now through prediction markets, which are under the hood just options markets. But this retail flow has meant that there's a bunch of different kinks to the term structure, to the vol surface, which means that you can't just apply the same conventions you have from equities to something like crypto. So at least for much of the history of crypto options, a lot of this attention has been focused on offshore centralized exchanges, places like Derive, OKX, Bybit, these kinds of places. The biggest difference is there is nothing beyond a 12-month tenor, really, in crypto. So Bitcoin options, ETH options, which dominate so much of the trade volumes on these offshore exchanges, if you're used to 10-year, 30-year options, those just have not existed for so long in crypto. That's changing a little bit now with ETFs. IBIT options, for example, do trade at those longer tenors, but so much of that in crypto is historically just not been there. At the same time, you don't necessarily see the same skew towards puts that you would expect from something like S&P, for example. In crypto, we like to have a melt up, not just a meltdown, where upside volatility is, and those massive black swan fat tail events happen to the right as well as to the left. One more thing to add is that crypto's volatility is not what it used to be, especially in Bitcoin and increasingly in Ethereum. I think a preconceived notion of Bitcoin and crypto volatility is that it is a high volatility asset. Yes, that's still true, but we're now seeing Bitcoin trade with vols on an annualized level below 30%. repeatedly in the last 12 months, and Ethereum hurtling down towards that same low as well. So it's not the same asset it was 2, 3, 5 years ago, where you had vols of 120% plus. You still get that in crypto, just in altcoins, in more exotic assets, aside from the majors.
Great. Sean, you've been in the market quite a bit. Anything that you'd like to add, from your experiences, from your vantage point?
Yeah, I think Andrew covers a lot of that really well. I think two things I might add would be sort of the vol, not just vol is, typically high. It's a bit lower now, but vol can be very high itself. So, on October 10, when you had the flash crash last year, you could see vols burst up like 60% in hours, if not minutes, right? And so definitely, not only are asset prices a lot more fat-tailed than maybe your more traditional assets, but the vol itself is a lot more fat-tailed itself. I think as well, this is something that we've always talked about a little bit internally, and I have some friends who are interested in it. The idea that you have a 24/7 market as opposed to 9 to 5 or 10 to 4, whatever it is, in the traditional world, and you don't have these circuit breakers, means that you don't, almost like counter to this, like you have a lack of gap risk that you do have in the traditional world. So, a lot of people like to trade market open in the traditional world. They also like to trade earnings. Those things don't really exist in crypto. So it's maybe the one sort of less volatile feature that crypto markets have that traditional markets do.
Nice. I was wondering if you guys, I have tons of questions I want to ask you guys, but I was thinking you both mentioned like high vols. Do you think that actually where the people probably misstep, and maybe I'm asking a question I have an opinion on, is that they confuse high with expensive? So they right away go in like, I must sell vol because it's like so high, etc. At the same time, now that it's low, it's not realizing, so it's not necessarily like cheap either. Do you think that people, unfortunately, maybe it's more the retail nature, they think like high, low automatically means expensive, cheap, maybe?
Yeah, as
I
you
think.
said. Sorry, Sean, go ahead.
No, you go, Andrew.
John, as you said, you're asking a question maybe you have a view on. I would say crypto options markets are surprisingly efficient in pricing implied vols relative to realized vols. I think we have rarely seen persistent and unexplainable premia in implied volatility pricing over and above realized. It still exists, but as the levels get lower, as people are selling this, that premium has compressed. And I say persistent because yes, it does happen. I think the inefficiencies in vol markets in crypto are expressed more maybe in the shape of the term structure rather than outright level of volatility. But also, I say unexplainable because you do have event risks priced in across the term structure quite frequently. So a really great example was the ETF launch in Jan 2024, and then again in November 2024 around the US presidential election. For months ahead of that, you had a very clear, distinct kink in the term structure priced in around that event risk date that rolled across the term structure as the date came forward. That I think is relatively efficient and surprisingly so for an asset class that maybe has a reputation for being a little bit crazy and a little bit retail focused.
Sean, did
I
you
would add
have
to
anything?
that.
Oh,
Yeah.
good.
Yeah, no, I would add to that. I think for, at least from my experience with retail, a lot of people really just want to look at the number and sort of see what kind of percentage-based yield that they would get. I think that's sort of the driving factor for a lot of retail. You saw that with like a number of vaults products and like, very early structured products from options back in the day. People sort of want to hold their BTC or hold their ETH or maybe stables, deposit it somewhere and sort of see like, I'm going to get 10, 20% returns on this stuff. So I think for a lot of people, it's really just looking at what the yield number is, and that's sort of their guiding principle. I think as well for a number of people, like monetizing certain assets, is sort of there when there is no real other avenue to use that asset. So like for instance, like on Derive, like we can use hype and k-hype, like these staked forms of hype as collateral, and that allows people to generate yield on an asset that has frankly been going to the moon over the last couple of weeks, and to generate yield on that. And I think that's a pretty compelling value proposition for people, regardless of how well it tracks, say, realized volatility.
Yeah. Sean, I was wondering, since you kind of mentioned vaults, which are probably something 2020 to 2022-ish, you also talked about some new developments, like you were talking about these hype and all that. I mean, maybe for our audience, since say November 2022 FTX, how would you kind of characterize what you've seen with regards, starting with you, and then obviously you, Andrew, the market's growth and lack of or having maturity, if that makes sense. Yeah.
Yeah, I think the it's grown. That's for sure. Like I think options open interest on BTC has gone up more than like 8 to 10 times over the last 3 years. Like just looking at Bitcoin, options open interest sitting around 40 billion now. And I think what used to happen is that a lot of people would, deposit into like very simple like yield strategies. Yield farming used to be an absolute, gigantic industry where you could earn, easily 3-digit yields with relatively low risk if you just do some looping. Those yields have now been crushed because a lot of those yields were predicated on high funding rates on, your Binances, etc. And so what you're seeing now are a lot of crypto hedge funds, high net worth people shifting their funds and shifting their trading to more sophisticated instruments like crypto. So that's sort of reflected in some of these numbers, the 40 billion number that I mentioned as well. As for maturity, I think there is still a bit of a way to go. So crypto options markets are still dominated by BTC. I think that's the vast majority of options flow, with ETH sort of a distant second. I feel like a more mature market would be a bit more diverse in those regards. Still would be like heavily tailed to BTC, but you would see more alts up there. More of the top 10, the top 20 should be featuring. Spot liquidity, I mentioned before, October 10. I think the fact that markets can dump 50, 60, if not greater percent in 15 minutes, like we saw on October 10, that's a very worrying sign as to how shallow liquidity can be at some points. Admittedly, things were quite overextended there. And then I think Andrew mentioned a really good point of like the short dated focus. I think the vast majority of crypto options are front dated months. So like the monthlies have the vast majority of open interest, and you see very little 3, 6, and at the very far end 12 months. So a more mature market, I feel, would have longer dated tenors and have a bit of a wider spread across those maturities.
If talking about derivatives markets specifically in crypto, then I think one of the biggest barriers to, maybe maturity is the wrong word, but more sophisticated instruments and adoption of more sophisticated instruments, I think, is the unprecedented attention that retail and institutions, in fact, have paid to perps over more less linear payoff diagrams. So that has historically been where retail has chosen to take its leverage and chosen to punt. And in return, institutions, maybe not institutions that are explicitly TradFi, I'm also talking about a lot of crypto native hedge funds, have had no reason to go and look at yields in options and derivatives beyond perps, because the basis trade and funding rate arbs strategies have been paying so well over the last 2 to 3 years. Well, maybe not in the last 2 or 3 years, because that trade has become incredibly overcrowded. Everyone has loved this idea. So many of our clients on the research side, who we work with on a sort of consultancy basis or advisory basis, so many of them are that profile of a hedge fund that has made a killing in that funding rate trade and then moved over to exploring option strategies or options overlays, because the yield that was there, which was relatively risk-free, delta risk-free, but not tech risk-free, all the rest of it, that yield is just not providing the same double-digit returns that they need. So I think that at least part of the explosion now into options and derivatives and less linear payoffs has come from institutions no longer being able to milk that cow. But it's interesting that that adoption comes from the seller of vol, or the provider, or the market maker, rather than the price taker. I think we're still lacking a shift from let's say price takers or retail, from perps, which they still love, to options. As we mentioned earlier, that started a little bit with prediction markets, but so much of the prediction market flow it's not just focused on, let's say, the monthlies or the weeklies. It's like 15-minute or 5-minute markets, whereas institutions are so much more happy to think structured products, where you have a big strip of digitals and you're selling vol. You want to do that, let's say, 10 years out, right? So you've got this strange mismatch of buyer of vol at the front end of the term structure, the very front end of the term structure, and maybe more structural seller of vol at the back end. So again, interesting what this may do to the shape of the term structure rather than something like the level.
Okay, yeah, totally get what you mean. Maybe, Sean, if you can even, we're already talking about DeFi. So again, maybe could you, you guys are focusing on the DeFi space, any new things that have been happening that, have kind of grown in that area? And, if you could also tell us what have been the more recent challenges that you faced maybe in the last 3 years in this space, and how did you address them?
Yeah, I think in terms of growth, like DeFi options have definitely grown in the last couple of years. Like for context, Derive has been around for give or take 5 years now. So it's still small relative to what you would see, your CMEs or derivatives. But what I think we've really been seeing huge growth over in the last like 6 to 9 months would be like options in the alt space. And I think this has been a really underserved market, especially in the last 2 to 3 years. So with Scholes, we launched our hype option markets that I touched on recently. We launched them about, what is it now, Andrew, like six-ish months ago. And since then, they've grown to be our second largest options market. So I think last week they overtook ETH in terms of open interest and trading volume. And so I think like that's reflective, obviously, of a lot of the attention that hype has received recently. It's having a really good sun run, but also that there are these assets out there that are currently unmonetized that people want to do stuff with. Sort of what Andrew touched on before, and I think that up until recently, a lot of this stuff was gated behind OTC dealings or trying to find a market maker in a very slow and cumbersome process requiring a lot of paperwork, and that's not especially fun. So I think that that's going to be a real catalyst for growth in the next 6 to 12 months. So I'm very excited about that. As for challenges, I remember coming onto the scene in 2021, and I think at the time there were like 5 to 10 different options protocols all launching within a few months of each other. And Derive, is formerly known as Lyra, is sort of like one of the last ones standing. And I think that it really goes to show and to underscore just how difficult building an options exchange is, and just how difficult options as an instrument are. They are orders of magnitude more complex than perps. You have nonlinearity and convexity, so that poses a lot of risk to whatever risk system you build in. Also, as well, just to traders and market makers, getting the liquidity is a lot more difficult than it is for perps. So your risk models also have to be updated, and that's a very non-trivial piece. And I'm no engineer, but from what the engineers at Derive tell me, there are so many pieces of the puzzle. Just because if you list a perp market, you just have to add one ticker, but if you list a new options market, that's another 500 symbols, all that need to be registered, and all the engineering magic that goes behind that. So over the last 5 years, we've been trying to figure it out, and it's always sort of like the Hydra. Cut one head off, two more sprout up. But we're getting a hang of it, and it's exciting. But there's always a new problem around the corner.
I mean, it sounded like you talked about the infrastructure, but I would assume data has been huge in it. Sorry, I cut you off, Andrew, but I was actually curious, how you guys have kind of jumped into that space too.
Yeah, so the Derive really put us through our paces, I think, because for helping Derive launch Bitcoin and ETH markets, the job is relatively simple, at least compared to alts and to more exotic assets. For those, there exist already liquid options markets that we can calibrate volatility surfaces to, and then provide that data for mark pricing purposes. For assets like Hyperliquid, which have not, have before launch not really had any liquid options markets listed, either centralized or decentralized, the task is orders of magnitude more difficult. You are tasked with providing a defensible volatility surface pricing model for an asset that you can't go and observe prices for in the market. So bootstrapping that market for alts has been a problem that we came to Derive to try and solve with. And now the result of that is that Derive's market for Hyperliquid has become the venue for price discovery for Hyperliquid, which we're incredibly proud of, and I think is an incredibly cool thing. You have such an exciting asset in Hyperliquid, and we are able to say that we put together the most liquid venue for options on that asset. These problems are not trivial, but the SVI models, Black-Scholes models, these are relatively well known. These are all maths that has been devised and passed down to us now. Where we're able to add value is in a lot of these engineering problems for bootstrapping these previously illiquid markets into a more liquid market.
I see. Okay. Maybe Andrew, since you've been talking, from a data, further expanding on things, from data and analytics perspective, what do you find is still the hardest to measure or compare cleanly across the different crypto option markets today?
Yeah, well, as I mentioned, calibrating vol surfaces to options markets that exist, that's relatively well documented and relatively simple. The tough part in this market and what we do is far more unique to this asset class or this technology. Stuff like data quality and cleaning. You have a 24/7 market where exchanges that you're calibrating vol surfaces to don't store or save down their own order books historically. You need to find ways to make sure that you're always on, always listening to the vols coming from exchanges. Cleaning that data once you've recorded it and listened to it is a whole other beast, especially with options compared to something like perpetuals, where perpetual swaps, you don't need to worry about a little thing called arbitrage, where in options, you have a vol surface that could very easily imply a price that can be arbitraged against yourself. This is one concern. As I mentioned, bootstrapping markets for altcoins that have never traded before is one problem, but a very similar problem is trying to bootstrap 24/7 markets for traditional assets, like real-world assets, gold, equities, oil. Trump has a habit of making announcements that are impactful to assets like oil, gold, and equities on the weekend, which means that modeling volatility surfaces to prices that no one is quoting over those weekends so that you can bootstrap a market is a very fun problem to try and solve. It's a completely different ballgame to perps, which just are looking for a linear market, which are also trying to solve that weekend problem. If you think of places like Hyperliquid and a lot of centralized exchanges, of how they launch perps on a weekend market. This is one problem. And then we add convexity and Vega to that issue, and it becomes a far, far more interesting problem to solve.
Sean, did you have anything you wanted to add on that, or?
Yeah, I think Andrew covers pretty much all of it. I think maybe the one thing that I would say is like hard to measure and just not super well reported is like the OTC market. I think that has sort of operated in the shadows for like quite a while now. I read an article, I think one of Wintermute's sort of quarterly or half yearly reports, where they said, I think maybe it was like, I'm probably quoting this a bit off, but at least like 50% of their volume was like on the OTC market. And I feel like it's quite a bit of an iceberg with regards to that. So I'd be very curious to, I don't know if that could ever really be revealed. Maybe that's kind of the point, that it is meant to sort of be a little bit less transparent. But I think that stuff is hiding a lot of information, and it's
Oh yeah,
very
definitely,
interesting to dig into.
definitely. That'd be, I guess great to find out the information. Actually, I was curious, Andrew, because you're talking about arbitrage, and then something kind of like clicked with me. I'm curious, do you think the fact that it's hard to take arbitrage out of the observed option vols, okay, not where it really should be, as Sean said, there's the OTC market. Do you think that is probably giving problems to exotic option models, which is why maybe less of these things have come up? So, in my head, I remember I was trading during GFC, and I remember when vols went like ballistic, you couldn't get the SLV to work based on on like the current surface that you saw. So yeah, even just for like end of day marks, oh, that sounds bad, of your exotic positions, you almost had to create a vol market that looks slightly different. But then when you're during the middle of a crisis and vols are like 40 vols wide, I guess where is the real mid? So yeah. Anyways, I'm just curious. Have you looked at anything like that, or I know?
It's an interesting theory. This reminds me of quite a few arguments I've had with our engineers, where I'm sitting there saying, "Well, it can't be arbitrage in the market because someone will have taken it."
Yeah.
They're like, "Well, that's the market, mate. That's what it looks like."
Yeah.
But yeah, I think a lot of this comes from incredibly illiquid markets, very wide spreads. Interesting, you suggest this might have implications for setting up or bootstrapping more exotic desks. This I don't know. And I don't want to answer. I don't know.
Okay, cool. No problem. No problem. Okay, maybe, we've been talking about the current market, how things have kind of grown. Maybe if we, think going forward, I mean, in the interest of time, and then you guys, I'll just let whatever you guys jump in, however, let's say, what matters more, do you think, for the next stage of, say, again, market growth? We could say development or maturity, however you want to call it. You think it's more on the liquidity, the building better analytics, maybe more observable data? That could be something that we've kind of said from the OTC thing, whatnot. Maybe better interoperability between venues, or any other kind of workflow tools you guys can think of, and as a little free for all. Just jump in, I guess.
I definitely think a better matching of buyers and sellers of volatility. Right now, I think retail and institutions are looking at different points of the curve and in different directions. I think prediction markets need to be married up with an influx of structured products desks from, let's say, banks or traditional finance institutions, who are less likely to be playing at 5-minute and 15-minute markets and more likely to be in 5-year or 15-year markets. Definitely better liquidity is always helpful. As you mentioned, tighter spreads on this stuff always helps. Potentially more visibility into the OTC market. This is an incredibly good point that Sean raised. So much of options flow in crypto, especially in altcoins and anything that isn't Bitcoin or Ethereum, happens in the dark, OTC. This is generally between like blockchain foundations and market makers, or founders and market makers. This is definitely necessary because we just don't have any of that data. So the more of that is brought to light and more of that is visible on an exchange, I think will help. And that will help the liquidity problem. Yeah, basically everything else in the chain of your question: liquidity, analytics, and then interoperability, I think, is fairly well served in crypto, at least in DeFi. Guys like Derive do a really good job of finding ways to allow users to take high yielding assets like hyperliquid in terms of returns, and then find ways to monetize the vol on those assets. So I think interoperability between assets is good. Between venues, I think, is also a DeFi native philosophy as well.
We interest of time, maybe give you like 30 seconds. Anything you want to add to that, Sean? I think we're about to go over, but I mean, that just means a good session. So yeah.
I think Andrew stole a lot of my thunder there. I think at the end of the day, a lot of it is just liquidity, 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 liquidity.
Yeah.
With more of that, it will get more of itself, better spreads, more interest, and the flywheel will circle in on itself.
Well, that's great. I mean, thank you guys for joining. I hope you guys enjoyed the session. I enjoyed it so much. I think we should do another session. Another time, maybe another venue, maybe Pier Bloomberg, who knows? But yeah, definitely, I enjoyed it. I hope you guys did too. And thanks again for sitting through this. And I believe there'll be another session, so still stay logged in. So thank you very much, Andrew and Sean. Definitely a pleasure.
Thank you.
Thank you.
Yep. Thanks.